Good evening, everybody. And yes, uh, the voice was not audible simply because we've just started. Uh, Welcome to this webinar on real estate and versus securities. Uh, the whole idea comes actually from the fact that a lot of times people look at different options and try to evaluate. While many of us have some securities markets investments in our portfolio, many of us also have real estate in our portfolio, but still, when it comes to taking a decision, we would love to have a comparison between the two. The whole purpose of this webinar is to identify certain areas and opportunities and see how best we can take advantage of this. So first of all, we'll look at these 4 points broadly. Some clear characteristics of real estate as an investment avenue. Then we'll look at the options available within securities markets and what do we do about it. Then we'll compare the two. And finally, can we combine the two? And are there hybrid options available? Historically, this has been one of the popular investment avenues, real estate. Before we launch the discussion, let's look at the potential alternatives within that, and then let's look at a couple of nuanced points that we need to keep in mind. So first of all, whenever we look at investing in real estate property, while there are multiple options available, three of the most popular avenues are investing in a residential property, investing in a commercial property, or investing in land itself. So first of all, I'm sorry, slightly bad throat. First of all, let's start with the residential property. Residential properties must be considered from the point of view of whether you are using it for personal consumption, whether the real estate property is bought for personal use, or is it an investment? And there is a difference between the two. The one that you are using for your residential requirements, while it is an asset in your balance sheet, considering it an investment may not be appropriate simply because an investment is often made for a certain purpose called a financial goal. This goal has a specific time period. So if we are looking at funding that goal through the investment, then at the time of the goal, we have to sell the asset and convert. Let's come back to the residential real estate that we were discussing about. We are saying any investment that you make must be for a certain purpose, and this certain purpose is what we call the financial goal. Now, at the time of funding the financial goal, we should be able to liquidate the asset or sell off the asset and convert it into cash so that we can make the payment for the goal. Now imagine the house that you are living in. If you have to sell that house to fund the goal, what happens? I mean, if you sell the house, your residential house, then there are three alternatives available apart from funding the goal. You either have to move to a smaller house, considering that less amount might be available, or you move to a rental house, or you move to a far off location, or from a large city to small city to a village. The house changes, and with that, the quality of life may change. And it may not be a wise idea to cut down on the lifestyle simply for the purpose of funding certain goal. While cutting down on the lifestyle is not a bad idea, it is personal choice. But if it is a choice, then that's a great idea. And from that point of view, always separate the residential house that you are living in from your investments. When you are looking at investment in residential property, consider that at some day you should be able to sell it without compromising on your lifestyle. The second point out there is whenever you buy a residential property, don't leave it vacant. Give it out on rent and generate income. Okay, so if it's for an investment purpose, leaving a vacant house would only deteriorate the house quality, and to that extent, the net realizable amount may go down, or you might have to go through incurring repair expense or maintenance expense before you are able to actually sell it off. So when you need money, you might have to first invest additional for making it sellable. So instead of that, if it's a running house, it becomes easier. So this is point number 2 on residential house. Commercial properties are a great investment avenue by themselves. You can buy small offices, even with larger ticket size and slightly better ability to manage. You can buy a larger space somewhere outside of out in the outskirts of the city that you are living in and convert it into a godown or a warehouse and give it out on rent to various large companies. So these are also good options. But the moment you look at giving away an office on rent or a small office to, let's say, for example, give it away as an ATM to a bank or the warehouse that we are talking about, in all these cases, you are generating a rental income by letting out this commercial property. And from that point of view, once again, like in case of residential property, this commercial property differentiate between the commercial property that you might need for your own business and real estate property that you might use as an investment. So segregating these things like personal assets, investment assets, and business assets, keeping them separate is always a great idea. The third avenue is investing in land. Now, one could say that I can also invest in agricultural land, but because we are talking about investment, we've not added agricultural land because agricultural land is useful for the purpose of agriculture, which is a business by itself. It is not just an investment. The purpose of investment is you invest money and you don't have to work. Your investment works for you and generates income. So I'm keeping the agricultural land away. But land could be in the form of undeveloped land. The argument a lot of people put forward here is land appreciates over a period of time. And from that point of view, it is almost always a great investment. Fair point, no arguments there. But it will eventually appreciate, and that eventually is not definable in terms of time horizon. So if you are looking at intergenerational wealth transfer, then taking an undeveloped land or investing in undeveloped land may still be okay. I'm talking about intergenerational wealth where you are not actually defining the time horizon and you get a sufficiently long runway. If it is for any shorter purpose, and shorter in this context is not 1 or 2 years, it could be even 5 or 15 years also. I mean, in comparison to intergenerational time horizon. In that case, if you invest in an undeveloped land, have a plan about what you are going to do with that land later. Are you going to sell it? Are you going to get some development work on that? For example, building a society, building a residential property, building a commercial property, whatever it could be. But have a plan about undeveloped land. Unlike the first two cases where we were suggesting that there is a potential to generate rental income, vacant undeveloped land does not offer rental opportunity. So we are keeping a land idle and losing out on the opportunity to generate some income out of it. If that's the case, then have a plan and let that plan not be too long term. Have a plan about the use of that land in whichever form. So the three broad types of real estate investment opportunities. The real estate as an investment offers many advantages, and we have highlighted four among those. Number one, you can see that land or building or property in front of you, and that ability to see the tangible asset gives a great degree of comfort. It feels safer when you are able to see that in front of you. It's a good psychological factor that you are comfortable. Yeah, I know it's there. It's very much there. And some of the biases that we talk about with respect to financial investments, for example, the anxiety with respect to what would happen to my money. That anxiety is on a lower side whenever investment is made in real estate. Over a period of time, real estate prices do keep pace with inflation. And to that extent, there is a potential to earn income or capital appreciation which is higher than inflation. The next point about rental income is also related to this inflation hedge principle. The rental income also, in majority of the cases, especially in India when you give it out on rent, in majority of the cases there is a rental escalation clause, and this rental escalation is typically in line with inflation or marginally higher than that. So if we look at rental as a regular steady cash flow, rental income coming from real estate could be rising, and to that extent even the cash flow keeps growing over a period of time. So it provides a good inflation hedge in terms of rental income. Apart from that, the value also appreciates over a period of time. And in so many cases, we've seen that if the investments are done in an area which develops over the years, then the investment returns are far in excess of inflation, even after payment of taxes. So these are, some of the advantages which real estate investing offers. But whatever offers advantages may also have some downside. Okay, I've just spoken, so I'll skip the slides because I've already spoken on all the points. Whatever has an upside, let's also look at the potential downside, potential limitations or disadvantages. First of all, the investment that we need to make would be large. Real estate properties are not available in thousands. Even smaller and far off places, these days, a proper apartment, a shop, and one would be, making an investment in a few lakhs of rupees. So the ticket size or investment amount is large. Compared to that, there are certain other avenues where the ticket size required is small. Now combine this large ticket size with another feature, the typical characteristic of real estate, which is it is not liquid. And that liquid meaning it's not easy to sell and convert to cash. Even when the times are good and properties are changing hands at a reasonably faster pace, there still is some amount of time gap between the time that you put it on the block and finally you get the money. As we all know, in most of the cases, the buyer is taking a loan to buy the property. And if the buyer is not ready with a pre-approved loan, in such cases, once the buyer identifies the property and decides to buy from us, then goes to the bank, that will only add to the delay. And that delay actually is a compromise on the liquidity requirement that an investor has. Along with this basic characteristic of less liquidity comes the fact that most of the real estate is non-divisible, which means you can't cut it into smaller pieces and sell off. It may be possible if the plot of land that you bought is large pieces and sell off smaller plots. So that is possible. But if the plot itself is not so large, then you can't cut it down further. If you invested in a residential real estate property, an apartment block, a bungalow, tenement or a row house, in such a case, you have to sell the whole property, and ditto for commercial properties. So to sell the whole property, you can't break it into pieces. So liquidity and divisibility both are absent in case of buying real estate directly. Then there are regulatory issues. After the Real Estate Regulatory Authority, RERA, has been set up and the act has been passed in the parliament, a little bit of easing has happened. But still we have, the registration of documents required, the lengthy agreements where the terms and conditions have to be seen properly or vetted properly. And to that extent, there still are certain regulatory complexities. Very often it is advisable to take help of lawyers in such matters. While real estate may appreciate over a period of time, the prices do fluctuate, and there are market cycles wherein for 10 long years, certain areas do not see property price appreciation even within India. There are long periods of time when the appreciation happens at a faster pace. So these kind of fluctuations add to the uncertainty. Recently, we came across one client of a financial advisor, and this client had taken money out of the mutual fund investments to buy a flat, a 3 BHK flat. 6 years later, so originally they bought it for roughly 2 crores, and when they sold it off, they made a net profit. So they sold off after around 7 years of holding period. They earned a net profit before expenses and before taxes. worth around 5 lakh rupees. So a 2 crore investment held over a 7-year period, and the total profit was 5 lakh rupees. So there are market cycles and there are fluctuations. So this investment appears to be safe, as we just saw earlier. It's not safe from all aspects. And I'm only restricting the discussion to the financial matters, and that's why the risk would be financial risk only. If you invest in an under construction property, you might be required to pay periodically, but the project may get delayed for various reasons. And the delay could also be on account of some of the regulatory complexities that the builder, though having good intent, but for some reason, some clearance is not available or some approval is getting delayed from the respective government or municipal corporation authorities or village panchayat, because of which the construction of the project keeps getting delayed. When it keeps getting delayed, your money, which was given upfront, that gets stuck, and there is no appreciation. The illiquidity gets extended for some period. And finally, while the rental income is a good steady source of income, if the investments, if the property remains vacant for a period, that period there is no rent. Secondly, even when somebody has taken the house on rent, there is a possibility that once in a while the payment may not come in time, or sometimes the payment may not come at all, and you get into a ugly and long battle. So having taken a look at opportunities in real estate, the advantages and limitations, let's quickly take a look at what options are available for most of us, people like us, in the securities markets. Like in real estate, we had 3 alternatives. Here also we'll talk about 3 alternatives. Now, I've deliberately not kept some of the exotic and complex investment avenues here. While some of these are available, you could add AIF into the list, you could add derivatives into the list. I've deliberately not added some of these stuff, simply because, first of all, derivatives have a purpose, which is actually not an investment by itself. Derivatives are useful for hedging, for arbitrage, or for speculation. But derivative contracts in India are short-term contracts. And to that extent, you really can't consider those as long-term investments. So that's one part. Of course, the associated risks are a completely different matter altogether, and various reports for last 3 years have hinted at 90% plus traders in derivatives have being lost money. So I've not added those. Broadly, equity, bonds, and mutual funds. Equity, part ownership in a business, offers potential dividend and potential capital appreciation. Capital appreciation is something that we typically look for. However, if you hold for long enough periods, then this dividend stream in many cases could become a good source of annual income, though it may not be relied upon as regular or guaranteed, but the dividends could be quite large over a period of time. The asset category called equity, if you've invested in a diversified basket of equity shares and you hold on for a long period, and you also invested at not so costly valuations, then investment in equity would provide good hedge against inflation. And there is enough data to suggest that except for those near peaks of the bull markets, if you invested and stayed invested for longish periods, equity has proven to be good inflation hedge. But the stock prices fluctuate a lot, and this kind of a fluctuation eventually is risky to the extent that when you buy, the prices could be high, when you sell, the prices could be low. Many have tried to time this entry and exit such that you don't exit at the top or enter at the bottom. But many of these attempts have not been successful. Secondly, if you are investing for your financial goal may not always coincide with the bull market in equity, so you can take out at higher prices. It may happen that your goal is due and there is a bear market going on. So that's the other angle as far as fluctuations are concerned. So equity has its plus and its negatives. Real estate debentures or bonds on the other hand, they provide safety to the portfolio against the same very fluctuations. They provide interest income. But if you hold till maturity, then you don't worry about price fluctuation. If you happen to sell in the market, then there is a potential price fluctuation which could be less than the equity markets, but you can't rule it out. Number two, debentures and bonds, if not issued by Government of India, are subject to credit risk. And this credit risk could be either delays in payments or a total default in return of money or payment of interest. Those are the pluses, but they are a good stability factor for your portfolio. Now, though I have put equities, bonds, and mutual funds as investment options, let me clarify out here. I don't mean to say that mutual funds compete with equities and bonds. They don't. Mutual funds are investment vehicles managed by professionals. They allow an investor to take an entry into equity market or debt market or a hybrid of both. So to that extent, mutual fund can be used to get an access to equity or an access to fixed income. It's not a competition. With that, there are multiple types of mutual funds which are available. There are open-ended and closed-ended mutual funds. There are exchange-traded mutual funds. There are equity mutual funds, debt mutual funds, hybrid, gold mutual funds, multi-asset. So a whole variety of schemes are available. And that variety becomes useful to tailor a solution for an investor's requirement. As I just said some time back, there is a professional management of the funds. There is an entity, a company called the asset management company that is managing the fund. And to that extent, you are getting the services of the experts. The cost payable for the services is reasonably small. The total expense ratio, as they call in the mutual fund industry, the total expenses charged to the scheme for various functions, including fund management. Now, those of you who know a little more about mutual funds may be wondering that, okay, there are index funds also available, and there we don't need professional management because the portfolio is only replicating the index. That is true. But when you talk about professional management, investing the money is one part of the whole business. Doing research is only one part of the business. But keeping records of the investors, keeping records of various transactions, issue of units, cancellation of units on redemption, servicing various requests that the investors may have, issuing account statement, then calculation of NAV, keeping custody of the securities with the custodian. All these functions are part of the same professional management. And to that extent, some amount of expenses must be levied for those activities. And that's why even if somebody is only buying an index fund, the expense could be less than a portfolio that is actively managed by fund managers. However, the expense would not be zero because these other entities need to be compensated for the work that they do. Even then, the total expenses that we pay to a mutual fund is far lower than what we would have incurred had we done it ourselves. And one of the reasons there is when we hire the services of various entities, it is only for one tiny portfolio, which is our individual portfolio. In case of mutual funds, all those tiny portfolios have come together and there is an economies of scale. Finally, the portfolios are, except for certain schemes like sector funds, the portfolios are well diversified. And that diversification, as they say, is the most common, most simple and proven risk management strategy. So that's the mutual fund. Now, when you look at the advantages and disadvantages of securities markets products, now this is where one huge disadvantage that we talked about in case of real estate, or rather two, they are easily taken care of. And these are the first 2 points. The liquidity is very high and the ticket size is reasonably small. Now, when the ticket size is small, you can invest as low as 500 rupees in a mutual fund. You can buy some stocks at 100 rupees, 200 rupees. You can buy debentures at 10,000 or 25,000 rupees. Reasonably small ticket sizes. And to that extent, even for large investments, you can do partial withdrawal. You can sell only a few shares and you got liquidity and divisibility available. The access is easy. Unlike in real estate, where each property is unique, and to that extent, there is no marketplace where you simply go and sell and somebody is there on the other side to buy. Securities markets have standardized products. One share of a company cannot be differentiated from another share of the same company. And to that extent, this standardization enables that I can simply go to the platform called a stock exchange, put a buy order. If there is a corresponding sell order from the other side, both the orders would be matched and transaction can be done instantaneously. That cannot happen in real estate because each property is unique and standardization is not possible. Now, we're talking about physical real estate so far. Then, of course, SEBI as a regulator has a proven track record and done a fabulous job. They start with the objective of safeguarding the interests of the investors. And to that extent, they ensures that the regulations are in order to increase the levels of transparency, making mandatory the disclosures as regular and in simple language, and ensuring that the wrongdoers are punished. So the regulatory oversight is also quite robust. SEBI has been there since 1992. I mean, SEBI Act was passed in the parliament in 92. So from 1992 to 2025, we are talking about more than 3 decades of experience that SEBI has. We did discuss about diversification. Now, this diversification is possible because of one big reason, and that one big reason is the small ticket size. which is where real estate has a limitation. That because the ticket size is large, to carry out a proper diversification, the amount required would be unavailable to most Indians. It'll be that large a size. If I were to buy 10 properties of 1 crore each, right? I mean, that's the kind of example that we are talking about. Choices, anyway, we discuss a lot about. And finally, these choices allow products or portfolios to be created or constructed to be aligned with the specific requirement and specific risk profile of each investor. If I'm an aggressive investor with a 10-year horizon versus I am a conservative investor who wants regular income for next 15 years, both the portfolios could be very, very different. And both are possible through securities markets investments. Once again, securities markets also have various limitations. Because these are open markets and people can come and do a transaction in the market, there will be a transaction price. Because different people come with their different opinions, and these opinions could be either based on facts and fundamentals, sometimes based on sentiments, and sometimes based on hearsay. To that extent, the prices in the markets exhibit wild swings, the fluctuations or the volatility, as we call it. Recently, whatever has happened in the all over the world, whether it's economic sanctions, whether it is increase in the tariff, whether it is wars, whether it is spike in oil price, whether it was disruptions of supply chain because of geopolitical events, all those can play out in the securities markets and the price may get impacted. And if the prices get impacted adversely, obviously that's a huge risk that we carry. Whenever prices fluctuate, there is a potential to buy at high price and sell at low, resulting in capital loss. But at the same time, whenever there is a credit risk in case of a debenture or a bond, you lose out because the company doesn't repay the money. If a company's share is what you bought in your portfolio and the company goes out of business, the share would be worth nothing. It's not just the price fluctuation, it is also the business risk that the company may be exposed to. When SEBI Act was passed in 1992, we moved to a disclosure-based regime. And this disclosure-based regime meant that SEBI mandates that all the intermediaries make adequate and appropriate disclosures so that an investor can take informed investment decisions. So their responsibility partially shifts to the investor also. The issuers or the intermediaries, their responsibility ends with disclosure. The investor responsibility starts that given that information, do you take an informed decision or not? Of course, those disclosures have to be correct. It can't be any misleading or wrong statement. So those are also part of the regulation. But given the disclosure, the investor is actually saying that, okay, I have understood, and now I'm taking a decision based on this fact. And that may be an issue with a good number of investors who may not be as savvy. So having said that, the investors who are not savvy, for them, mutual fund works out to be a good investment vehicle. Now let's look at a small comparison between real estate and securities markets. And these are on 3 counts. Number 1, real estate is less liquid compared to securities market investments, including the divisibility part. This liquidity also offers a compelling investment process. You can regularly keep investing. If you buy real estate, the only way you can channel your regular monthly saving towards that real estate is by taking a loan and making EMI payments, which carries a cost called interest. In securities markets, instead of borrowing, those small investments can be parked in various investment avenues. In mutual funds, we call it SIP. And most of you could be familiar with that. So that's a huge advantage that is offered because of small ticket size and liquidity. The same small ticket size and liquidity also allows you to keep partially withdrawing over a period of time. And that may not be available in case of real estate as well. Securities markets are regulated by SEBI. Real estate markets are regulated by RERA. Of RERA, slightly biased, they also regulate builders and not necessarily only the investment part of real estate. SEBI actually specializes in the investment arena, and to that extent, their regulations are more focused and detailed. The second difference is RERA is a relatively new regulator, whereas SEBI has gone through multiple market cycles, multiple good and bad time periods, and to that extent, that combined experience has made the regulations that much sharper. Whether it is real estate or securities markets, one can expect in form of current income, which is like rental from real estate or interest from debentures, or capital appreciation over a period of time, and often both. But when you look at the investment risks, there could be some major differences in the sense equity markets are volatile, debt markets carry the default risk and also the risk of fluctuations in interest rates. But in case of real estate, apart from price fluctuation, lack of liquidity is a big risk. Though the title on the slide talks about investment risks, real estate also suffers from certain other risks, including potential encroachment. The paperwork not being in order, the titles of the property not being clear, and those risks also need to be taken into account. And if that's the case, now I'll come to one question that was asked earlier by Sushant Vaidya. Sorry, not Vaidya, Sushant, is it Vishwanathan? Sir, we can directly buy a land is not possible, then we invest in REITs. And that's exactly what I am proposing out here. You can invest in real estate through a particular product which is available from securities markets. And that product is called Real Estate Investment Trust, or REIT. REIT or REIT is structured in a similar manner as mutual funds are structured in India. So consider it this way, that instead of buying stocks and bonds directly, you can access the same through an equity or a debt mutual fund. In case of REITs, instead of buying a real estate property directly, you invest through this investment vehicle called REIT. Let's look at basic characteristics of REITs. REITs invest in income generating real estate properties. So they are not really getting into under construction properties, but income generating properties, which means the properties are ready and there is a rental income. Out of this rental income, 85 or 90%, I keep forgetting that exact number, 85 or 90% of the rental income has to be distributed to the unit holders. So the unit holders can expect to get regular income the way an investment in real estate would have generated rental income. The REITs are investing in commercial real estate and not residential real estate. There is a team of experts which does the assessment, and then accordingly they'll invest in real estate properties. But the idea is to provide regular income, not so much of capital appreciation. It's only a few years back that the first ever REIT came to the market, and we don't have too many options available. There are around 4 or 5 options available as of now in the market. That is a slight dampener. However, with the increasing interest from the investor increasing, the mutual funds, insurance companies, and pension funds also now allowed to invest in REITs, and with the limits being increased, the chances are that their participation may also increase. When more and more money comes in, we may see more options coming in. But as of now, it's a nascent stage. As of now, the options are limited. Even if the options are limited, the investment in REITs offers some advantages. First of all, and again, I think somebody had mentioned it earlier about liquidity. So yes, REITs offer liquidity. Ticket size is small compared to buying a physical real estate property. While I've written liquidity here, in the next slide, I'll say that liquidity is not very high because the options are limited and interest is still low. So as of now, listing is available. Some amount of trading activity also happens, but it's not as liquid as most of the stocks may be. The great advantage of REITs is, like real estate, it offers diversification against stocks and bonds. So REITs is a real estate product, and to that extent, the real estate prices and stock prices don't move together. Considering that there is a steady flow of rental income, REITs also offer stability to the portfolio. So it's a good case of diversification. The properties are professionally managed. Now, whenever you have a diversified portfolio, so let's say if I'm buying physical real estate myself and want to diversify, then the management of that real estate portfolio becomes a challenge. In this case, like a mutual fund, there is a professional management team, and they take care of the management of properties, collecting the rentals and stuff like that. On the real estate side, RERA is the regulator, and on the REIT side, these are listed products. Units of REITs are listed on stock exchanges, and to that extent, REITs come under the purview of SEBI. So there is a SEBI regulation as far as REIT is concerned, and their investments in real estate, they come under the purview of RERA. So between the two, the regulatory oversight is sufficiently strong. Because there is professional management involved, it makes the product even safer from various other risks. Because they invest in income generating properties and pass on large part of the income to the investors, the regular income is also something that investors can look forward to. Because units are listed, the prices fluctuate. Number two, as we just saw, options are limited. And because the options are limited, and the other fact that while units of REITs are listed, sometimes people compare the price appreciation in REITs with the stock markets. And you don't see that kind of an appreciation because a large part of income is distributed. And to that extent, a lot of people are still not investing in REITs, making the liquidity that much lower or poorer. As we see, over a period of time, this market is likely to grow even further. There are opportunities visible. I just mentioned some time back that mutual funds, insurance companies, pension funds are also now allowed to invest in REITs or buy units of REITs in various of their products, and the limits are getting increased. So to that extent, there's likely to be institutional participation, and with rising investor interest, we'll see more and more options coming in, the market growing relatively faster. The regulators, through introducing sufficient safeguards and allowing more options and increasing the limits, they are also trying to see how the markets can be grown further. And if that happens, then the chances are that more and more number of investors would come in, more and more products would be available to us, and that augurs well overall for the market. Before we end, let me add one more point here. Apart from REITs, there is another product called InvITs. InvITs are infrastructure investment trusts. They operate in a similar manner as REITs, except that REITs invest in commercial real estate. InvITs they invest in infrastructure projects. But there also, you can expect to get regular income in form of dividend. InvITs, we've got 2 or 3 more issues compared to REITs. So number of options available under InvITs are more. You may treat REITs and InvITs as similar assets when you decide to do allocation towards real estate. But because the topic of today, we had decided about real estate, so I did not talk too much about InvITs. But they invest in infrastructure projects like toll roads, toll bridges, etc., etc. Just to conclude 2 major points, the opportunities are diverse within securities markets. And now with real estate investments available under securities markets, an additional avenue is available. Doesn't mean that you stay away from physical real estate always. That's not the idea. But while that exists, here is another opportunity which is present. So you can evaluate and take a call as per your suitability. Because REITs as an investment avenue, they combine the liquidity, small ticket size and convenience of securities markets products while offering the capital appreciation and regular income like a real estate property. So to that extent, they consider these as a hybrid kind of an investment avenue. Right. So with that, we end the session. There are, I believe, some questions. So let's just take a look at those questions. Okay, so this is under Q&A. Can we lend underdeveloped land to agricultural business Okay, so underdeveloped land is essentially the non-agricultural land. If you want to give it for agricultural purposes, then it should be agricultural land. The moment you convert agricultural land into non-agriculture, then you would have incurred some cost. So to convert agricultural land into non-agriculture, and then after that you don't give it for agriculture purpose. The underdeveloped land is what I was referring to as the land on which some construction can be done. Now, looking at your questions from another angle, can we lend that, give it out on lease or something to someone to do the agriculture activity? Yes, you can do that. Now, consider that also as lending that asset to somebody for business purposes. So it's more like a loan, but not given in monetary terms. You've given it in a physical land format, and you are taking some rent. If you're taking rent, then only you've done the lending part. If you're taking part of the profit, then you contributed to the capital for agriculture. Just be clear about that part. Will the impact of government policy have a greater effect on real estate or securities? When that depends on which policy, Kaushalji, we are talking about. And it's more about specific policies. Having said that, if let's say Reserve Bank of India, for example, decides to increase or decrease the interest rates, then that decision itself can have a wide-ranging impact on both real estate market as well as securities markets. If the government or the RBI decides to liquidity in the economy, that can have major impact on both the markets. But then there could be certain specific policies, and they would have specific impact on different segments. Antima Kaushiki, I'm sorry I missed your question at that point in time, but bonds and debentures are IOUs, which means somebody is borrowing money and the investor or the lender gets the principal back at the time of maturity. And between the time of investment till the time of maturity, the company may pay interest. The borrower may pay some interest in some form. It's like a bank loan that you take, with only difference being, in case of a bank loan, it is between the borrower and the bank. In case of bonds and debentures, these are securitized instruments, or the entire loan is broken down into smaller parts called bonds or debentures, and these are tradable in the stock markets. Is it worth investing in REITs vis-a-vis second property? Deepti, my sense is you evaluate from multiple angles. REITs would offer you better liquidity, more choice, professional management, and smaller ticket size. A second property does not offer these benefits, but a second property gives you that sense of security because it is tangible, it is visible. REITs, they are just an entry in the demat account. So when the tangibility is missing, psychologically, there may be a feeling of anxiety or insecurity. But REITs would also mean that you are giving away the control of management in the hands of somebody else. A lot of times people have argued that REITs offer lower returns compared to the property that you own yourself. Now, if you adjust for various costs that you have to incur, including the physical effort of maintaining the property or cost of maintenance, then the chances are that both of them may offer quite similar appreciation and regular income. So it may not be a big difference, except REITs are a little more convenient compared to physical property. What are the average historical returns from REITs in India? Is there a lock-in period? No, REITs are freely tradable. Narpatji, historically, because there are different products and we are talking about different time horizons, I don't have the exact data. The only thing that I can tell you is that the dividend yield is closer to 5%. So if you invest 100 rupees now, then annually you can expect close to 5% dividend income. And that's been the track record. I don't know going forward how much will it be, but historically that's been the case. Is capital appreciation possible, whether exiting REITs after a few years, or is it mainly for income? A larger part would be income, but capital appreciation is possible. It may not be large, because large part is paid out. It's the standard little bit of appreciation that may happen in the property valuation. If the interest rates drop and the properties are leased out for longer periods, then there's an additional appreciation that may happen. But REITs are largely for current income. Minimum investment 25,000 rupees. How we get return from REITs? Deepak Parmarji, as I said, it's the dividend that the company pays out of the REITs. REITs get rental income, and large part of that is paid out. If the REIT books capital gains, then again a large part of capital gains will be paid out in form of dividend. Do companies have regulatory restrictions regarding investments in different types of real estate? So yeah, REITs, Ashutoshi, as of now, they invest in commercial real estate. They can invest only in income generating investments. Whenever REITs will be available for investment, REITs are already available, Rajkumarji. You can check on the exchanges. The units are available for anybody to buy on any business day. How to invest in REITs? You need a stock broking account with a stock broker, or the so-called trading account. You need bank account, and you need a demat account. Get your KYC done, and you are ready to go. Through that stock broker, you can buy units of REITs. You don't even need to wait for fresh issue. REITs, whenever a new REIT is launched, there will be an IPO kind of an arrangement, but you don't have to wait for that. You can simply buy from secondary market. Is there chance of interest on REITs going down? Oh, very much. Sanjeevji, so there is a quite a high probability that the interest on REITs may go down, because if the lease or the rental income goes down, the interest is also likely to go down. But let's understand how often is it possible, right? The rentals going down. The only other thing that you need to keep in mind is, if the property remains vacant for some time, then again you lose out on the interest income. Okay, thanks. Which one is, from a tax perspective, which one is more efficient at the time of liquidation? Dividend income would be added to your income and tax at the slab rate. Rental income that you get is also added to the income at the slab rate, except some maintenance costs can be adjusted against that. So to that extent, rental may be slightly better. Secondly, take a loan, and again, I'm not a chartered accountant, so I'll not go too much into detail, but you take a loan, and that interest may be available for set off in physical properties, but not necessarily in REITs. How REIT is better than fixed deposit? Piyush, it's not about what is better or what is worse. Fixed deposit has its own purpose. REITs have their own purpose. Fixed deposits are a good avenue when you are looking at short-term parking with a good degree of safety. REITs have the potential of increasing dividend over a period of time because the rentals may go up, while you can't rule out the possibility of reduction in the income from REITs. REITs also may see capital appreciation over a period of time, which doesn't happen in fixed deposit. REITs are perpetuity, so you can decide your holding period. In case of fixed deposit, the deposit period is also fixed. So if you have longer horizon, you will have to reinvest. If you have a shorter horizon, you have to prematurely withdraw. and you get to know after doing the fix what that is. So these are a few differences that you need to keep in mind. There's nothing wrong in either of the two. Okay, so let's look at a few questions from this side. How the value of assets taken into consideration, book value or market value in REITs. So there are professional valuers, Dharmeshji, they have to periodically do valuation, and multiple valuers are to be empaneled for the purpose of valuation. So the valuation of the properties is actually done at market value, or not really the market transacted value, but the valuation done by the professional valuer. Would interest cut trigger real estate prices to go up? Durgesh, historically, that's exactly what we have seen. Whenever there is a reduction in interest rates, prices of almost all the assets tend to go up. Income generating assets in particular tend to go up. So yes, it should apply to real estate as well. Are there any minimum maximum cap specific? Yeah, so REIT size at 25,000, not very high, and there's no maximum limit as such. How do we get the benefit of capital appreciation if the property is not sold? As I said, Sunilji, earlier, the properties would anyway get valued, and that valuation, through a valuers. And that valuation would reflect in the prices. So if there's an appreciation, the prices would automatically get adjusted. Some REITs which can be purchased now. Chetanji, I would not take any names. You go to the exchange website and search for REITs. You would get the whole list. Then do your independent research on each of these and then take a call. Why not InvITs instead of REITs? Durgesh, as I said in the end, the title of the presentation was real estate versus securities market. So that's why I restricted the discussion on REITs. But yes, InvITs is also a good idea. And again, instead of REITs, I would say InvITs and REITs both are good options. What types of courses available for REITs so that we can deeply learn? I think NISM website has Ayushji a few webinars, learning modules on REITs. So you may just check it out. Extra or max fees can be charged. No, so those are regulated, Shakti Variaji, and they are part of the offer documents. Again, regulated, so there are caps imposed, and to that extent, there's nothing extra that somebody can charge. What happens if I can buy and hold REITs for long term? Sushantji, you will continue to get the dividend income, and over a period of time, as the valuation appreciates, you will get capital appreciation whenever you sell. Otherwise, you continue to get regular income. Looking to purchase a residential property to stay through loans, EMI of 45K. So where to invest in securities to compensate some amount of loan? I did not get the question, Chetanji. To compensate some amount of loan. Well, if you are saying that you want to take a loan and simultaneously invest, please keep in mind that in that case, you are leveraging your personal balance sheet, and leveraging is a high risk proposition. So check whether and take help of some professional investment advisor who can guide you. Don't go overboard. A little bit of leverage is not a bad idea, but too much of a leverage could be harmful. So if you are asking whether I can invest some money somewhere in securities markets that grows higher than the interest on home loan, well, it is possible, but not guaranteed. How frequently it will be done? Dharmesh is asking how frequently, what would be done? Are you suggesting the valuation? Yeah, so there is a certain frequency. I don't remember the exact frequency. I think it is once every 5 years or so. So can I know in REITs that where the professional investing particularly, yeah, so that those disclosures, Surajit ji, are available. I hope this session was useful to all. Yeah, thank you so much. Thanks everybody for your patient hearing. Thanks a ton.
Thank you so much, sir. I would like to extend our heartfelt thanks for taking time to speak at the webinar. Your insight, expertise, and engaging presentation made a lasting impact on audience. Thank you, sir. Thank you again. Also, thank you to participants as well for being part of it. Thank you.